members and guests, would you please welcome to the stage Tim Longes of Swan Global. Tim.
The Melbourne Mining Club is again very pleased to welcome a distinguished overseas speaker to address this forum. Mr. Gary Goldberg is President and Chief Executive Officer of Colorado-based Newmont Mining Corporation, one of the world's leading gold producers with operations in the USA, Australia, Peru, Indonesia, Ghana, and New Zealand. Before joining Newmont in December 2011 as Chief Operating Officer, Gary spent some 30 years with Rio Tinto, where he served in a number of senior positions in its gold, copper, coal, and industrial minerals divisions. Ultimately, as President and CEO of Rio Tinto Minerals, where he was responsible for some 19 mines and 29 processing plants. And he's certainly no stranger to Australia, having been Managing Director of Coal and Allied Industries from 2001 until 2004, and indeed served on the government's Business Roundtable on Sustainable Development. Both sustainability and safety are among his core objectives, and as chairman of the National Mining Association of the US from 2008 to 2010, he led the CEO's Safety Task Force and its Core Safety Initiative to substantially reduce mining accidents. Gary was appointed to the #1 job at Newmont in March last year, so we are therefore delighted that he has found time in his busy schedule to come and talk to us today. Please welcome Gary Goldberg to the Melbourne Mining Club.
Get everyone turned around so they can face the right direction. Good afternoon, and thank you, Tim, for the kind introduction, and thanks for having me here to speak with you today. I hope you'll allow me to expand just a little bit on the career path that brought me here today. I began actually as a copper miner in Utah in 1981. Then I dragged my family to Colorado, in northwest Colorado, to run a coal company. Next, we packed up and moved the family to London, where I worked at the Rio Tinto's Gold and Other Minerals product group. From there, it was to Wyoming and another coal business. Then it was here to Australia, as was mentioned by Tim, and the Hunter Valley to run Coal and Allied. Next, it was off to California to run a 100-year-old borax mine. And before too long, we moved our headquarters to Denver, and we picked up the salt business, Dampier Salt, and the talc business, Luzenac Talc. 5 years later, I managed to stay in the same house, but moved over to Newmont and to gold mining, where I suspect they hired me because of my last name. If you're like my family, you're wondering, why can't this guy hold on to a job or make up his mind about what I want to do when I grow up? I like to think of it a little bit like the 6 blind men and the elephant. In this parable, 6 blind men touch an elephant, and each comes away with a different perception. One feels the elephant's side and thinks he's touching a wall. The second feels the tusk and thinks that he's touching a spear. The third feels the trunk and thinks that he's touching a snake, and so on. By touching many different parts of the mining industry, I've gotten some perspectives on the whole animal, and would like to share some of these with you today. Specifically, I'd like to talk to you about what makes gold a distinct commodity and what makes it the same as any other kind, and to discuss what we are doing to make Newmont a distinct mining company, the gold standard for the gold industry, if you will. After all this, if you walk away with nothing else, I hope you'll be able to answer one trivia question. And that question is, who is Australia's largest gold producer? I'll give you a strong hint now, and it's Newmont. Newmont has been in business nearly 100 years and was founded by William Boyce Thompson. He named it for New York, where he made his money, and Montana, where he grew up. Newmont started as a highly diversified business in 1916. We even made hats. Today it is one of the oldest companies publicly traded in the New York Stock Exchange and the only gold company listed on the S&P 500 index. The company is also distinguished as a pioneer in the gold sector. We were the first to extract value from invisible gold, or gold that you could only see with the use of a microscope, and the first to commercialize large-scale gold heap leaching. Our portfolio was shaped by two major transitions. The first in the mid-1980s, when we faced 5 different takeover bids, including one by T. Boone Pickens. This prompted the company to divest all but its gold assets. The second was in early 2000s, when we completed a 3-way merger between Newmont, Normandy, and Franco-Nevada. We then embarked on a decade of major investments in Nevada, Australia, Peru, Indonesia, and Ghana to become one of the world's largest gold producers. Today, we are headquartered in Denver and have about 30,000 people working at managed operations on 5 different continents. With that plug, let me get back to gold. If you enter the word gold into Google, you get about 640 million hits. Now that's a heck of a lot of information, but I believe there are a few basic facts about gold that are not fully understood or appreciated. First, gold mining has been around since prehistoric times, and there have always been people who were bullish on the metal. In fact, until the late 16th century, most people believed that gold grew underground like a plant. These early miners thought that deposits should never be completely mined. Rather, they left some gold behind to act as a seed to grow more. Second, gold has been used as money for more than 6,000 years. The quality and value of gold has been trusted like no other commodity. Currencies have come and gone, but gold continues on. Hence, you have the gold standard. Third, the reason they call it a precious mineral is that there's precious little of it. Consider the facts. It's harder to find a 1 ounce nugget of gold than it is to find a 5-carat diamond. Less than 175,000 metric tons of gold have been mined since the dawn of civilization. This entire amount, which is about as much iron ore as the world produces in 32 minutes, we had a lot of fun calculating different ways to compare it to, you could imagine, would fit in a volume 21 meters cubed, and I know I've had predecessors who've talked about how that would basically fill this arena here. Finally, more than 90% of the world's gold has been mined since the California Gold Rush. While tens of thousands of people flocked to California in 1849, nearly 100 million people around the world rely on gold for their livelihoods today. By the way, if you'd like to be buried like King Tut, you'll need about $5 million just to pay for the mask, which contains about 110 kilograms of gold. Moving on to market forces, gold breaks the laws of supply and demand as often as it obeys them. Gold value depends on the amount of confidence investors have in the metal, not the industrial demand that matters for most commodities. Many investors consider gold to be a better investment than stocks, bonds, and cash during times of financial turmoil because it's a hard asset. Gold value is also affected by world crises, but not always predictably. Demand for gold is split into 3 categories. About half of the world's gold is used to make jewelry. Last year, China surpassed India as the world's leading gold consumer. Gold jewelry continues to signify individual wealth as a very traditional dowry in India or as a very modern status symbol in China, where daily gold prices, as shown here, are posted in shop windows. About 40% is used to manage financial risk in investment portfolios and protect the wealth of nations in the form of gold bars and coins and in electronically traded funds. Currently, central banks remain net buyers of gold, and in many countries, gold is more reliable than currency as a way to store wealth. The final 10% is used by industry: cancer treatments and malaria tests, telescopes and catalytic converters, touch screens and dental fillings. All of these use gold in trace amounts. Whether you flaunt it, use it, or store it up, gold is a proxy for wealth. Gold supply generally matches gold demand, but you might be surprised by where gold comes from and which countries produce the most. Total annual gold production last year was 86 million ounces. As of 2013, China was the world's leading gold mining country, followed by Australia, the United States, Russia, and Peru. South Africa, which had dominated world gold production for most of the 20th century, has declined to 6th place as their deposits have matured. Of these top 6 producers, only China and Russia have increased their production from 2003 to 2013. Other major producing countries include Ghana, Burkina Faso, Mali, Indonesia, and Uzbekistan. It's worth noting about 1/4 of world gold output comes from artisanal or small-scale mining. In general, practices are neither safe nor environmentally friendly, but they are a very real part of many countries' economies. Working to raise standards or introduce alternative livelihoods is one of the complex issues we're working with governments to resolve in places like Indonesia, Ghana, and Suriname. Finally, scrap constitutes a significant supply source when prices are high. While I get a lot of reports, the real way I can tell that gold price has lost its shine is when I see fewer advertisements on the television aimed at getting people to swap their household gold for cash. Something you don't see in the salt business, by the way. 3 other things make gold slightly different from other commodities. First, gold consumer marketing is at its infancy. We do a bit of trade promotion, and some efforts have been made to differentiate green gold and conflict-free gold, but we have much to learn from diamond producers who've really done a phenomenal job of working to create markets for their products. Second, logistics are just not a huge part of our business compared to bulk commodities like iron ore and coal. Instead of transcontinental railroads and big ships, we transport doré metal by helicopter and airplane. Third, our investors are purists. Diversification is a dirty word to gold bugs, something you don't immediately appreciate when you come from a bug-free background. I learned this after a reporter asked me what I thought about Las Bambas, a copper gold deposit in Peru. I told him it was an interesting deposit, which led to an article with the headline, "Newmont Interested in Las Bambas." I've certainly had a lot of explaining to do about that one. So next time you're checking your investments, note that gold is not even included with other precious metals. It's in a category and a class unto itself. While the commodity itself is different than others, the business of mining it comes with many of the same challenges. Major assets are getting older and grades are declining. The industry spend for exploration has increased 5-fold over the last decade, while the number of major finds has decreased to 1 to 2 per year. Investors' appetite for funding mining megaprojects has also dwindled. possibly because the industry has had such a bad track record delivering a return on the investment. As with all commodities, and maybe even more than others, host governments tend to look at gold mining as the panacea to very legitimate issues like employment, revenue generation, and economic development. This temptation is not limited to emerging economies either. We are working through new agreements in Ghana and in Indonesia, but we're also fighting potentially crippling tax and royalty hikes in Nevada and in Western Australia. Part of this is our own fault. Until recently, what we reported to the market was our cost applicable to sales, which represents just a fraction of the total cost to produce an ounce of gold. When you report costs of $500 an ounce and gold is selling for $1,300 an ounce, it's no wonder governments are looking for a bigger slice of our pie. We need to do more to understand our respective realities and tackle these issues together. Before I move on, a word on one of our biggest elephants in the Newmont's room, and that's on Indonesia. Despite our best efforts to resolve the export issue, we have yet to achieve a satisfactory outcome. As you know, Indonesia's new export restrictions and duties are in conflict with our contract of work. Our team was forced to halt operations in early June due to our inability to export copper concentrate. Realistically, we cannot continue to produce without generating revenues. Logistically, there's simply no room left to store additional concentrates. We're pursuing two parallel paths to resolve this issue as quickly as possible. First, we're continuing our efforts to engage with the government, which we hope will lead to resolution outside of arbitration. At the same time, we filed for international arbitration to ensure our rights and our assets are protected for the benefit of our stakeholders. The request for arbitration means that we will seek interim injunctive relief to get our people back to work and to resume exports. In the meantime, we do continue to ship copper concentrates to PT Smelting's Gresik smelter. The outcome of arbitration is obviously difficult to predict. We estimate that it could take several months to obtain a ruling on interim relief, and at least several weeks then to ramp back up to full production if that relief is granted. In the meantime, we continue to seek a fair resolution with the government of Indonesia, more specifically with 3 ministers, a coordinating minister, untold staffers, and now 2 separate administrations, which has been a lot like trying to figure out what an elephant looks like when you're blindfolded. But we're not giving up. Our support for the people of Indonesia deriving full value from their natural resources remains unchanged. Our local economic contribution includes 9,000 direct and indirect jobs. We have paid more than $3 billion in taxes and royalties to the government to date. And we have demonstrated our commitment to supplying PT Smelting and other companies that intend to build copper smelters in Indonesia. Although we've been fortunate to have strong community support for resolving the export ban in Indonesia to date, another piece of common ground is that community expectations around the world are rising and diversifying, regardless of the commodity. In general, expectations have shifted from mining companies doing no harm to their having a net positive impact across a wide spectrum, including employment, procurement, infrastructure, education, and healthcare. Communities are also concerned with what you pack up and take with you when the deposit is exhausted, and also what you leave behind. Roads, power lines, schools, and hospitals are all things that are okay. Global warming is not. While we all address challenges related to energy and to water, I think the trickiest environmental issue is climate change. You know better than me how government struggles with emissions controls, carbon offsets, and taxes. But the last time I checked, the environment does not stop at the border, and the solution needs to last longer than an election cycle. While I don't agree with Bill Clinton's policies, or all of them, I recently participated in the Global Clinton Initiative and agree with him that addressing climate change is something that must be grounded in economic reality, solved on an international basis, and executed over a 20 to 30-year time horizon. The last thing that we have in common with all miners is the fact that our investors are disappointed, and we've had a lot to do with that. We have not been as efficient as we could be at controlling costs or as judicious as we could be on investing in growth. While these issues are not new, there are a few more pieces of the elephant that I've put together since being named CEO in March 2013. I joined the company at the tail end of the 12 years of rising gold prices, and in the rush to produce volume, we lost track of value. Many of our people had simply never lived through a downturn, and we had to help them learn how to live within our means. Another thing that I've learned is that everyone has an opinion about what will happen to gold price, and most of them are wrong. As Lee Clifford used to say, all ships float on a rising tide, but it's not until that tide goes out that some of them hit the rocks. Controlling what we can control is critical, no matter the cycle. I also learned that as smart and methodical as you can be, sometimes stuff just happens, like it did in Peru with our Conga project, becoming the central platform for the last round of national and regional elections. The current president ran on a platform of water, not gold. Then he changed after the election to water and gold. Now, slogans can change overnight, but it takes years to build trust. Finally, I've learned that culture matters as much as assets and cash flow, and should really be recorded on the balance sheet. Our people are proud to be part of Newmont and dedicated to doing things right. While it's hard to measure, it does show up in our safety record, our ability to achieve $1 billion in cost and efficiency improvements over the past year, and in employee engagement scores that outperform all industry averages, including the mining industry. Touching another Newmont elephant, it was our culture that led us to self-select out of doing a deal with Barrick. Whenever you talk about these types of deals, the common themes are synergies and redundancies. While there were several synergy opportunities, there was not enough redundancy in our culture and our values. This lack of redundancy eventually meant that we were not able to pull in the same direction and achieve the full potential synergy value of the deal for our shareholders. Our culture is strong, but there's always room to reinforce it and make it stronger, particularly as new generations join the team. We recently went through a process where we refreshed our vision and value statements to clarify why we're in business and how we do business. Seasoned employees thought that we existed to create value and improve lives through responsible and sustainable mining, in that particular order. The next generation thought that improving lives should come first before creating value. While behaviors matter more than statements, it's important to clarify and test your collective purpose, strategy, and values, and to make sure they fit together and you're all seeing the entire elephant. Our strategy has one goal: to regain gold sector leadership in the next year, and 5 pillars that mark out our path. Health and safety. A safe operation is an efficient operation. But more than that, it is possible for each of our people to go home safely every day, and anything less is unacceptable. Operational excellence. Stakeholders expect us to get better and more efficient at mining, and we have the technology and the experience to do that. Consider that the first mobile phone cost about $4,000 in 1973, and you can get an Apple iPhone today for about $200. In contrast, the cost of building a gold mine increased significantly over the last 10 years, from $560 per ounce of annual gold production capacity in 2004 to an estimated $2,400 per ounce of capacity today. With prices hovering around $1,300, cost and capital discipline is a must. Growth, because you can't create sustainable value without it. We recently announced a decision to invest $1 billion in our Marion project in Suriname. This project took 10 years. In fact, we've given 10-year safety awards and service awards to employees there to get to this stage. And it's been an important turning point, both for our company, but also for the country. Sustainability, because you can't secure permits or social acceptance without it. And most important, people, because you can't run a mining business without them, and you cannot be the sector leader without the very best in the business wanting to be part of your team. This purpose and strategy is grounded in common culture, and our goal is for every member of the Newmont team, whether they work in the rainforests of Suriname or in the Northern Territory of Australia, to understand the complexities we face and to be empowered to make decisions that balance competing priorities between stakeholder and shareholder interests, safety and efficiency, sustainability and profitability, and discipline and growth. At the end of the day, and now at the end of my speech, if you can't see the entire elephant, you need to feel it. And that's the new gold standard we're looking to achieve at Newmont. Thank you for your time, and I'd like to open things for questions.
Okay, members and guests, we're open for questions. There are two microphones. Richard Shoddy's got one here. Ian Howell's got one here. I think Ian Howell's got the first question. Members and guests, if you have a question, could you please stand and identify yourself and your affiliation? Please, the first one.
Thank you. My name is Clive Whittington. I confess to being a nickel person, not a gold person. Many thanks for a walk through the industry globally and the position of Newmont. Much appreciated. Being somewhat out of date in gold business, I was interested that South Africa has fallen to number 6. And I wonder if you could just enlighten us as to the reason for that. Is it that the Witwatersrand has run out? Is it cultural? Is it economic or political?
Oh, great question, Clive. Thank you. And I have to admit that without having our own operations in South Africa, I'm not across all the details there. Part of the challenge, like all mining industry we face, is deeper mines and more technical challenges as you work at that depth. So just having the resource to be able to get to the resource is part of the issue. I look at where we're very successful in Ghana, for instance. It's mines that are fairly close to the surface, fairly soft ore, and reasonably easier to get to, so that's part of the difference. But clearly labor challenges, and you see that in the press, not just in the gold mines, platinum mines, and really all the labor strife that we've seen go on. There's been another one of the challenges to sustaining production and where you'll attract investment, I think, is also one of the challenges they face.
Gary. Sorry, Adrian Prendergast from Bailey Holst. Thanks, Gary.
Thanks, Adrian.
I just got back from Diggers and Dealers, and there's definitely a rising optimism amongst the industry going forward in terms of perhaps tackling and improving on economics with costs. And you touched on that in your presentation as well in terms of the cost environment in Australia, which can be quite high and sometimes even restrictive. How do you see that evolving going forward more naturally? And in addition, what can Newmont do to tackle it, or some of the other industry leaders?
I think what I've seen in our industry, it's not unique. With gold not having seen a downturn for so many years in price, you see a lot of people now focusing very much on it. It had been, what could you do to grow, and whether it was a marginal project or potentially an acquisition along the way, people weren't focused on running their businesses efficiently. So I think a lot of people are tending to that. I think you'll see some groups that are doing it effectively, and I think it's important as we look within Newmont to reduce our costs, that we look at what we can do in a sustainable way. Anyone can cut costs for the short term, but at the end of the day, we're long-term businesses, and we've got to make sure we're thinking about the long term when you're going through and making both cost and efficiency improvements. So I think that's what will set folks apart, those who just do things in the short term, Adrian, versus those who have an eye on the longer term. That will, depending on what happens with gold prices, I'm not expecting any major changes here for the next couple of years. That's how we manage our team in terms of how they do their plans, and it's best to keep that focus and controlling what we can control within our own business.
Gary, my name is William Morgan from Intrinsic Investment Management. Gary, can I ask you to reflect on mining tenement law? Slightly unrealistic question possibly, but we see in the US huge strides in getting coal seam gas developed and government out of the picture and things getting done, compared with Australia where the government owns the mineral resources but things don't get done. Do you have, in your broad experience, any reflection on whether we should reconsider the law that we use here?
Well, I think the U.S. is still working on a mining law that came around in the early 1840s. So I'm not sure that's the model I would go to for following here in Australia. I think the one thing I would point out that I'm familiar with in terms of the oil and gas development, and especially the fracking and natural gas in the U.S., is most of that development is actually happening on private lands and not on public lands. So that is still a challenge. You can point to the booming coal bed or the natural gas production that's been produced from horizontal drilling and fracking, but it's still all been almost done exclusively on on private lands, not on public lands. So I'm not sure I'd look to the U.S. as the role model now. As I look, we deal with different structures and regimes. I think having a good, firm legal basis in place to wherever you're at is a critical piece to have. So that would be the other piece I'd point out.
Good afternoon. Being a recent geoscience honours graduate, I was wondering if you could offer advice for someone trying to get into the industry, in the sense that jobs in Australia have been a bit harder to come by, and I was wondering, given your international experience, what it's like to branch out internationally for jobs elsewhere.
Great question. When I started in the mining business in 1981 and started at Bingham Canyon, I never dreamt that I would be working outside the United States in my career. So I think don't limit yourself on where you might end up as one. When I began, they had you fill out a thing, what were your short-term and long-term career goals? At that point, my long-term career goal was to be the mine manager at Bingham Canyon. Now, I was fortunate to be able to achieve that by the time I was 30 some odd years old. And I guess don't set your sights too low. I think at that point it was probably the right thing to look at, but to work hard does pay off. And in a downturn, you actually face many opportunities to do lots of different things. So I think that's another piece to look to. So good luck on your career.
You mentioned that of the 6 countries or 10 countries that you referred to, 2 being Russia and China, had increased their production over the last decade. I'd be interested in hearing from Newmont what's been your trend in exploration expenditure over that decade, and where the production is going to come, or the new resources are going to come from to provide the production to maintain your current production. In other words, if exploration is falling, and tell us your specific example, where's the new gold going to come from?
Oh, I think, and thank you for your question, we're no different than the rest of the gold industry and mining industry in particular. We were spending roughly $500 million a year on exploration when I joined the company in 2011, and we were looking in a lot of places difficult to get to, helicoptering in and expensive to do the exploration. So we've shifted our focus around some of our existing operations. It's not the only place we look, but that's where we seem to have had some good success. In Nevada, with extensions of some of our underground operations, here in Australia at Tanami, the Federation deposit, which we hope to talk more about later this year or early next year, is an extension of the Tanami ore bodies. But in my experience, you should start looking first of all around your existing ore bodies, and that's what we've done, is we've reduced our spend, put it where we see the most potential, and that's had some pretty good results for us so far. Oh, Owen.
Thank you. Owen Hegarty from Tigers Realm Group and EMR Capital, the new force in resources private equity. Gary, thank you very much for that. A wonderful speech and entertainment. Thank you. Excellent. And also describing why Newmont is indeed the gold standard. So well done with that. My question relates to Indonesia, and you gave us an explanation of the company's position there. Thank you very much for that. A couple of recent events there, the election, the presidential election, and a populist new president, so to speak, but also Freeport and their recently announced, well, I don't think they've started the export of concentrates, but announced an MOU. So a couple of recent events there, and just wondered whether that is the beginning, perhaps, of a change of policy, number one. And secondly, what is the long-term hold for Indonesia? Indonesia, very prospective, obviously, very important for Australia and Australians in terms of the relationship we have there. So just perhaps a couple of longer-term comments too. Thank you very much.
Thank you. Thanks, Owen. A great question. And we've been in Indonesia now over 20 years as Newmont, and have worked under the contract to work. And those contracts of works, Freeport's is a little bit earlier version than ours. They're all different stages, and they've evolved basically back to the mining tenement question that was asked before. In 2009, they issued a new mining law, really looking to not only support the local mining industry, but to support downstream processing. I believe there's, from my standpoint, it's something I actually understand, the desire to process minerals in country. There's a belief, and I think a perception, that employment comes with that, and added value in the country comes with that. The reality, when it comes to copper concentrate production, we extract essentially 95% of the value in country in Indonesia, but that's not how people look at it. They tend to believe there's more value by doing smelting. So that's been one of the fundamental differences. I think, I'm not sure that I see this as a change in policy. I think they're continuing to work through what's the right direction and right path to go. I'll let Freeport comment on their own approach to that, but we have worked actually over the last couple of years to make changes that make sense. These contractor work being done 20 years ago, there are things that make sense to change along the way, so we've been exploring that. But we're now at a point, having had to shut down the operation on June 5th, and at a point where we're not moving forward, that we need to look to try to help bring things to a conclusion, or where we can at least get some certainty going forward. I think in the long term, I think Indonesia is a great place to be doing work. They've got a change, Jokowi coming in, the newly president-elect will start in October, I think offers some opportunities to build on some of the successes of previous democratic elections and leadership that's come through, but it continues to evolve, and I think it's one that we need to continue to be flexible to work with, but recognize that we do have commitments from the government to work with them to develop the resources for the benefit of all in Indonesia.
We have one last question up here to the back right.
Gary, thank you. David Lafurla from Negotiation. You've made reference to the importance of enhancing productivity, stripping out costs, stripping out waste, enhancing employee safety, environmental responsibility. These are things that we certainly agree with, and they resonate with us. Gary, I wanted to know about your views on the partnerships that Newmont is forming in order to bring about those step changes that will bring about sustainable lifts in outcomes for a number of stakeholders. Thank you.
Thank you. I think there's a number of very successful partnerships that we have, whether it's with our suppliers. We've tended to be a long-term Caterpillar They've been our supplier of choice when it comes to mining equipment in particular. So working closely with the vendors, and not only on terms of buying the equipment, but how it gets supported. So it gets back to local employment and local content. For example, when we built, and we just started a mine in Africa, in Ghana, Achim, late last year. One of the things we did as we looked to start that up, we actually took people from the village and local employees, as we call them, took them to our existing Ahafo mine to train them on more skilled roles like equipment operators and mill operators and mechanics. In fact, I visited with some of the apprentices. But making that investment up front and early before we started the mine, so that when we started Achim, we actually started up with over 40% local employment at Achim, which is actually better than we're doing at Ahafo. So that's an example of some of the partnerships that we've worked that way. I think ultimately we're in partnership with government. Local communities are the best place, and I can point, once again, I'll go back to Africa. We have a development foundation at Ahafo, and I got to visit there earlier this year where we've helped, we put money in and seed money based on a percentage of our earnings that goes in to fund it, but it's really local ideas that are then used to generate projects. And we're helping to fund a nursing hospital, and it starts up actually later this month, and it will draw for students from around Ghana, and we'll have about 100 students. So we help to build the facility, not only the nursing facility, the training facility, but the sleeping headquarters and places for people to stay. This is something that's going to be there well beyond the life of the mine at Ahafo. It's going to be out there for the next 100 years. So those are some of the examples that I think that we can do, and we do in a lot of places. I know a lot of people in this room could cite numerous examples of where the mining industry builds long-term sustainable value in the communities where they work.
Okay.
Great.
Gary, we'll just pause for a moment then, and could I call to the stage Patrick Smith, the boss of AMC, to propose a vote of thanks. Patrick? Thanks, Gary. Move that so I don't knock it over. At the start of Gary's presentation, he asked us to remember one thing at the end, in anticipation for a curly question at a quiz night. I'll take away a few other things from Gary's presentation, in addition to recalling Newmont's position in gold production in Australia, and interesting ways to apply the elephant parable in conversation. The third part for me in Gary's presentation was the willingness to change direction and the willingness to address challenges when they present themselves. Time moves on, mining industry and commodity markets change, and companies cannot stand still and await the market to come back to them. So, small or large challenges, be they cost and things that are somewhat within our control, or government-related and more outside of our control, must be evaluated, understood, and addressed. Could you please join me in thanking Gary? And we have a token of our appreciation for Gary.